Cool. Good morning, everyone. Welcome to today's panel on the VC Playbook, Unveiling Strategies for Winning in Web3. So my name is Pei Wu. I'm the moderator for this session. So we are delighted to have you here to explore the latest trends of the opportunities, news, and challenges in the world of crypto with LPs and VCs. So I think next step we can let me introduce our distinguished panelists. So Xiao-Xiao J, the operating partner at KKR, Yaroslav, the partner at the faculty group, and the Gideon is on the flying back. So cool. Each of them will bring a wealth of knowledge and experience in NLP and VC side. So should we give a quick intro of ourselves, please? So Yaro, you want first?
Hi everyone, thanks for being here. Faculty, so I'm a partner at Faculty Group. We're a VC and a venture builder. So we believe in not just deploying capital, but also helping companies go from A to B. So we have a services arm, a product arm, and a broader venture studio as well. So.
Xiao-Xiao here, operating partner at KKR. KKR is one of the largest investment firms, private equity investment firms in the world. We invest into many, many assets. I'm in the TMT space, so deal with a lot of our big tech companies, but I also basically cover our strategy on crypto and blockchain. And as part of that, we have invested from our balance sheet into a number of top crypto VCs. So I have a good insights into that space, and obviously passionate into the space general. I've been a tech founder before joining KKR, so yeah, looking forward to this discussion.
Thank you. Pepe, I'm the managing partner at LBC Capital, which is a Silicon Valley-based single-family office. We're backed by one of the largest asset managers in Asia. So we are very focused on the fund of fund and direct investment in crypto and AI. So cool. So first question. What do you think the differentiative between the hype and the substance when evaluating Web3 startups? What specific signals do you look for that indicate a Web3 project has a real potential?
I'll take it first. So I'll take it in steps. So I think there's a few kind of cool basic kind of tenets we look at, which you look for any company. It doesn't matter Web2, Web3. It doesn't matter what you're doing, which is, are they addressing the right problem solution set? Is there a viable commercial model that wraps around it? Is it sustainable? Is the market big enough? Do people care about the problem? So you look at the kind of that piece first and foremost, and then you look at things like specifically the team, because when you're investing in, seed stage, where typically we play a lot, it's always about the founding team, and it's always really kind of, are they able to? Because often the product they start with isn't the product they finish with. And I think we've seen this time and time again with big companies. And so you spend a lot of time looking at the founders. And do they have the capability to execute? Do they have the track record of not just working at big brands, but actually executing and moving the dial in those big brands? Do they have the agility to pivot when they need to? And I think, have the humility to do so as well, because it's very hard to walk away from, let's say, been building a product infrastructure that has found product market fit and then lost it. And actually pivoting to something that people fundamentally want. So really it's kind of looking at the product, as I said, the product and the market side. It's really looking at the team. And then of course going into the weeds of how all that pulls together. So I'll pause there.
Yeah, I think it's quite different if you're like very early stage or when you're like investing into slightly later stages like we do. Early stage, as I agree with you right there. Very early stage is first and foremost about the team, quality of the founders. And then it's, I think, about the market, because the market needs to be sizable enough for a founder to make a difference. And then it's only product, because product can change, depending on the market. And if the founder is good enough, he can even change the market, right? Like that's sort of the order, I would say, of priorities. But when you get obviously later stage, then what you actually evaluate is you have some kind of product market fit already, and then so what you invest in is you decide on the category, on the market and the category, and then which position in that category you want to basically back, right? Do you want to back the leader, or do you want to back a challenger or like a newcomer, right? That there's like different ways you can sort of play this role. And then what becomes, of course, very important is there is an existing product or tech that serves the market and the customers. Then you have to obviously go much deeper into the due diligence of the product and technology, as well, obviously, of the financials, because then you have proof points, right, that you can evaluate to assess whether the product and tech is sustainably, serving the demands and can also win against competitors. I guess if I boil it down to sort of very, very simple terms, that's sort of how the evolution of the life cycle of VC.
Yeah. So add on that, I think the strong use case and also the market fit is very good for the traction, also for early stage. And for what we are looking at is more about like the people have the strong and solid technology from the very beginning, and then they can gain the traction from the very, like a market cycle or over that. Yeah. So it means like a real world problem solving. Yeah. So it's definitely for us. Cool. Second question. So given the volatility and the rapid innovation in Web3, so how do you balance risk versus reward when you're making the investment decisions? Also, this is the first.
I think there, again, you have to distinguish between very early stage and late stage. I think when you come from a more sort of very established institutional player like where I work, there's, I would say, a broader set of risks that you have to consider, right? It's not just about the investment outcome of the individual investment decisions you're making, but then obviously, there's like downside for the entire platform or the institution when it comes to sort of if companies you invest in run into regulatory problems, ESG problems, compliance problems, then these can have actually much bigger downside than any upside you can get on the individual sort of investment. So that there's obviously a number of risks that we evaluate before making investment decisions. I think on the earlier stage, and that's why our strategy in Web3 is actually to back some of the top, early stage investors in the space, because they obviously have less of these sort of constraints. They can they can obviously evaluate on a day-to-day basis the most interesting founders and opportunities, without necessarily having to think about right now is this SEC compliant or not, right? And so I think on the earlier stage you have a different calculation. It's a portfolio strategy, right? So you can actually have you can allow for several of your investments to kind of not make it or run into different sort of problems. That's okay, as long as you sort of you are pretty certain that you can back at least one or two really outstanding ones that can outperform expectations. Keen to hear your.
Yeah. No, I'd add to that. I mean, with the early stage, and you're exactly right. I mean, how you invest into companies and how you frame the risk, assess the risk, and also how do you mitigate that risk, it really varies. So we've done less in the pre-seed. We've done typically more seed stage stuff. And as you say, you go through the typical process of sourcing best deals, doing a lot of diligence to make sure you're backing the right founders, and then ultimately pulling the trigger. And again, numbers show it can be a statistical game. One of the key things that we believe in is that this whole value creation. So when we built Faculty early days, it wasn't about, we've got a VC and we did off the balance sheet investing, now we've got a fund of it, but we've built a whole venture building ecosystem. So on the services side, having a marketing business who then helps around communicating the value proposition, building your community, the PR, attracting the right supporters in the community and actually helping founders tell the story in the right way, in the right channels and attracting the right audiences, and then wrapping data around that. And again, I'm a very kind of data-led, data-obsessed guy when it comes to how do you get the most out of every dollar spent. So that's the marketing side. Whether it's market making, for instance, when you're launching, how do you know, should I be spending $500,000 launching on a tier 1 exchange, or should I be doing a DEX first strategy? What's the kind of ROI on this? So, and then how do we make sure that we don't get front run? All these things are going to happen when you're launching a token, and the place is the minefield. I mean, we've made the mistakes ourselves over the last 6 years, so we try to help our portcos avoid them. And so we're building that, and then finally you've got the kind of labs business, which is all around how do you bring in the right auditors to make sure your contracts are bulletproof. How do you help them develop different products? How do you accelerate product market fit through introductions and just being obsessed about talking to your user? So I think when it comes to the early stage venture building part, post-capital deployment, it's all around how do you help companies get from A to B, making sure they're doing the right things at the basics, but being involved with them in the process. And then that's really helped, I guess, we're very opinionated, and it's helped to offset some of the risk when we see founders making mistakes we've seen before.
Yeah, I think I would only add is, obviously as an investor, the most important decision you're making is before you make the investment, right? But at the same time, you have to take calculated risks, right? Because if there's no risk, you don't have return, you don't have reward. So it's all about how you assess and how you deal with the risks. And I think more and more important, I fully agree with you, and that's whether you're in early stage or later stage, right? I think value creation after you kind of make the investment is just gonna become more important to differentiate against competition as an investor. Because where there is a risk, you have to really eliminate the risks that you simply cannot control, that are binary, right? Like just regulation or like something that's just definitely gonna, that can just wipe out your business, that you have to kind of avoid. But then there are things that you can actually support and control and influence, right? Helping management and the founder on the right sort of, investment decisions, M&A, which ones to go after, how to finance those, how to expand beyond your core market, how to expand your product portfolio, how to strengthen your sort of tech and cyber capabilities, how to boost your ESG credentials, etc. That's obviously on the playbook of the later stage, but you have obviously other challenges, right, in early stage to find product market fit in the first instance. But I think, yeah, it's about a careful evaluation of the risks that you are willing to take and willing to sort of put efforts behind, and then limiting the risks that you just cannot control. Right?
Yeah, great points. From the faculty marketing, it reminds me of, so I can see a lot of founders or leaders today, so maybe not many Asians here. So at the beginning, LBC, we acquired one of the largest crypto media in Asia, and the DAU is top 2. So the other one competitor is Foresight News, but a very good partnership. So after we acquired this, so like you said, if we want to value add to our portfolio companies or to support even the VCs, we would like to support to know more about, or let more Asians to know what's happening in the Western world. So that's why we usually do Chinese. If you open our application every day, they're like an instant, like every 2 seconds, there are the new news. So super fast and super more update, like quickly. And DAU is more than, I think, 30K, so it's massive in Asia. And it's only Chinese. The UI, UX is quite good. And backed by like millions readers and audience in Asia. Even the Token 24/9, they are the sponsor. Also all of the Asia big events. So that is the way you're sharing the marketing space. So that's why we also do that. Cool. So next question. So we know the faculty group is a collective, like a market maker, marketing, VC, extra. So you go to a lot of different sectors. So from your side, what would you give the advice to Web3 founders that it comes to like fundraising strategies or dealing with the investors?
Yeah. We'll break up into 2 parts because there's the pitching and approaching the VCs, and then how do you structure the raise and how do you make sure you get what you want. I mean, from a pitching perspective, I think for the first thing is, when you have the first conversation with the VC, they will have read your pitch deck. And so one thing I love being asked, and I frankly speaking I do it myself, is before we start this conversation, before you go into a big pitch, what would you like to hear from this? Are there any specific topics you'd like me to focus on? I love to be asked that question because then we can just save time and really nail down the things that are important and we want to hear. Because there's a lot of what I do sometimes see is that pitch decks include very table stakes features that aren't necessarily unique and we don't necessarily need to hear about, or something I do already understand. So I'd love to personally go into a bit more. So that's the first thing. So really asking the VC, what is it they want to hear from this conversation, get from this conversation? And it want to actually give you a chance to highlight the key things that you actually want to kind of bring out. That's the first thing. The second thing is focusing on, we talk about product market fit and traction a lot. And one of the things that I want to maybe double down on is around this notion of being engineering focused versus being product focused. So engineering focused, we build something cool and let's see if it sticks. Product focused means talking to your users and generally building for problems that you're not just seeing conceptually in this space, but you have validation for having talking to a bunch of people in the market and say, I will buy this if it was built. And that is a very important distinction. And the way you demonstrate that is through either early traction numbers to show people are using your product if it's more of a B2C thing, LOIs, pilots if you're more on the enterprise side, and just demonstrating that people really want what you're building, and that's informing how you build rather than just conceptually building something that might be a ZK part of a stack somewhere that no one fundamentally uses. So that's from a kind of a pitching perspective. I think from a kind of structuring, so I think it's fair to say VCs talk to each other, and there's a lot of due diligence sharing, comparing, and understanding. What do we like, what don't we like, what are your thoughts here? Because everyone has their own expertise. There are things that we may miss, that our friends catch, and vice versa. So I think that the really important thing is going out to friendlies first when you start to raise, really calibrating that pitch and how you frame yourself. Number one, and then once you're there, really speaking to folks and getting warm recommendations, because if one VC likes you, ask them, they typically co-invest with others, and they'll typically deal share with others, and ask, is there anyone else I should be speaking to? Because if you have a warm introduction to another VC, it's much more likely that they'll prioritize you in favor of the tens and hundreds of decks they see every week. So that'll be my kind of top advice.
Cool. And also following that, how do you measure the success in Web3 startups? And are there metrics beyond the financial returns than the more valuable area?
Yeah, it's a good question. I think there's certainly what I would call more vanity metrics, and then I think there's kind of the real metrics. I mean, and look, there's important things that we all know. If you have a token price, of course, is a great marketing tool because we've seen with Sui recently. Tokens gone up 4x in the course of last 6 weeks, and guess what? More builders are looking at Sui. It's a fantastic tool to actually attract users. So from that perspective, it's good. I guess it is more of a vanity metric, but it is important. The ability to, of course, if one raises a big round, of course, that adds more eyes to it. But I think what most VCs will dig into much more is the real pieces, which is really, again, understanding, who is using your product, who are you building for, how have you pivoted, or what have you learned in the last 6 months, 12 months, 18 months of building that you know what works and what doesn't. And I'll use an example. I have a very good friend of mine who's building basically built an NFT marketplace on Solana. And at the time when he pitched me this, NFTs was just going down. This was like 2 years ago. So this is an absolutely horrible time to be building this. But I know the guy is just obsessed with users and obsessed with building something that is good. And guess what? He bucked the trend. And it's Tensor, by the way. Tensor's the marketplace I'm talking about here. And they've done a phenomenal job in that respect. And this constant iteration. So I think, just being obsessed about building not for a raise or not for a token price, but actually building for something that's going to survive the narrative, the ebbs and flow of the different narratives that we have in the space. Those are the key kind of success metrics for us, because these are the projects that fundamentally have the fundamentals to kind of stand the test of time.
Cool. Thank you for your input. So would like to pick a brain from Xiao-Xiao. So how do you see the balance of power shifting between VCs and founders in Web3, especially the emphasis on decentralization?
Yeah, very interesting question. I think Web3 is so interesting because it just created a new form of bootstrapping, capital formation for entrepreneurial spirits, right? I think with this sort of ability to kind of tap into a more public and liquid market relatively quickly, much quicker than sort of in a traditional VC space, and the ability to kind of bootstrap operations and the community aspect of funding. So it's much less geared towards, if you want, you can actually be much less reliant on professional VC investors as a founder, right, in this space. Obviously, the dynamics change between bull and bear market quite heavily. But I think generally, I think you have probably, you have more avenues to kind of fundraise, just in terms of channels. Obviously, in the traditional VC space, a lot of VCs now would not necessarily deploy or look at crypto anymore. So that's a sort of a part of the universe that you don't have access to. But I think you have a lot more to sort of experiment on. You have a lot more leeway, and I do think it changes the dynamics between VC and Web 2 versus Web 3 founder, because in Web 2, Silicon Valley Bank is gone, so I mean even debt is much harder, right? So it's really VC equity financing that you're looking at, and that's for a long time before you can raise anything else. In Web 3 it's different, and there are many successful examples where successful projects, protocols didn't have major VC investment, or just had very little at the beginning, and then they found other ways. So I think that makes it hard for allocators like me, right? Because you want to back into a very high quality, early stage private investors or asset managers. But if they don't have access to top founders, because these top founders can list directly, it's difficult to then sort of cover the market. So I think it's good news for founders, right? And I think there will be constantly new ways for founders to kind of find ways to kind of engage their communities and fundraise at the same time. I do think the regulations will catch up. It has to be obviously done in a way that protects sort of retail investors. But I think, VCs probably have to find a way to kind of, to be able to competitive, you have to find ways to kind of demonstrate more value add to founders than just capital access. This is way more important in Web3 than Web2. Yeah. That's probably my take.
Just add to that, I think and for any projects in the room as well, you should be asking more of your VCs, so people on your cap table, because I'm sure people have take a lot of energy to curate who is an investor in my business, and often, one of the things we do is we will go in and actually understand who is on the cap table and who's actually doing something to support the project, and so you should be asking more of those who invested in you, understanding who can offer what beyond capital. And then those are the folks, because we're in a space which is changing incredibly quickly. And what VCs do have and bring to a project is the ability to see what else is going on in the industry and what else is going on. And any VC who's going to tell you this is how you should 100% do something, no one knows for certain, right? And until very recently, someone would say you have to list on a centralized exchange when you do a token generation event, because that is a way to go to market. And if you look at the historic path of it, what you tend to see is a big spike up, and then things are going to regress down if they don't have the following behind it. And so there was one of the Arthur Hayes wrote about this recently. One of the companies, Alki, did with DEX first launch and disclosure. There are portco vows. But it was a big discussion, and they've done very well off the back of it, because again they've got the fundamentals and the traction behind it. They've built a great community based on the product that they have, rather than any necessary hype narrative. So I think asking more of your VCs, getting their opinions, getting their input on what they believe should happen, but then putting it through your own filters and using them to either get access to markets or getting access to exchanges or whatever you need to move you forward.
Yeah, I would also add, I think the breadth of what VCs bring to Web3 projects is very large. And in a space where, as a founder, one of your key exit paths is actually being listed publicly, right? If you have on your cap table a lot of VCs that don't add a lot of value and are just looking to sort of dump at the first unlock, it's going to hurt you, right? And so you have to actually balance that, right? Like, when you actually do your first rounds of raise, I think you really have to do diligence who you bring on board, right? What record do they have, right? On past projects, because VCs need to make money as well. But in what time horizon, in what fashion they do that? How careful are they in sort of really protecting the overall market cap of the protocols, or are they only just going after maximizing the gains on their stake? I think there is conflict, right, baked into this model, and I think longer term thinking, really value adding, investors will differentiate over time, because that's going to be their reputation, and good founders and good projects will always want to look for those that create win-win situations for the long term. And then likewise, right, I think good VC investors will always want to kind of partner with founders that don't want to just cash out at the first moment. So I think it's a mutual selection process.
Cool, thank you. How many VCs are here? Oh, few. Okay. So as we know, Xiao-Xiao led the crypto investment at KKR, and you did a lot of VC investment as LP. So what advice would you give to VCs regarding the liquidity events in the Web3 space?
Well, liquidity events, yeah. I think ultimately, that's not founders, right? These are investors. Look, ultimately, for long-term LPs, right, that are deploying into funds, not just once, but repeated basis. Ultimately, the one metric that matters is DPI, which is basically funds, the capital returned in relation to the capital that you put in, actually returned, right? Not just paper marks, because that just obviously unlocks the liquidity, and you can reinvest again, or you can do other things with the funds. Obviously, in an early more emerging tech space like crypto, it's different, right? Because in bull markets, the liquidity event can be much faster than in traditional VC. But then, in bear markets, when things are not going so well, it can actually be longer as well, right? Or you don't want to necessarily cash out, or as a VC don't want to sort of sell at below your mark, right? And so I think ultimately the one metric that matters is DPI, and obviously before you can get there, there's leading indicators. You have to obviously evaluate the portfolio of the team and the approach and the differentiation and reputation of the VCs. But I think ultimately, especially when we're also talking about, okay, how do we unlock the LP space outside of those that are already very interested in crypto, because ultimately that institutional adoption, that sort of more general LP adoption will benefit the space overall, because it will help to kind of bring more capital into the space, that a professional that is long term, right, that is not just looking to get out as very quickly, and that can help probably also professionalize some of the investors in the space, who in turn will help professionalize how founders think about building value and building businesses. So I think overall that will be helpful. But in order to sort of attract those non-crypto, native, non-crypto, interested LPs, I think DPI is just the one thing that really matters and helps, because that just answers a lot of other questions.
That was very informative. So time is tight. We'd like to open the floor to 1 to 2 questions. Any questions here?
Awesome. Thanks. I'd just like to hear your opinion on whether the onus should be on VCs not to dump tokens, or whether it should be on projects to design sustainable tokenomic vesting schedules. And if the onus is on projects, what might that look like for a project?
It's a bit of both. It has to be a bit of both. I don't think it's fair to displace one or the other. If a project is going to market with a very low float, high FTV, that's a red flag, at least in our book. Because, and exactly to your point, there's the NAV component of what is a project worth. You know, if you think of the FTV as the NAV, the reality is you're looking at circulating supply. So by the time the DPI is obviously the money you actually get out of the project, that's going to be a lot lower. And when it comes to actually designing the token metrics for it, I think it's both on the project and the VC, because the VC, there is a healthy tension. There's no doubt about it. Because if we're being very kind of cynical about it, you know, from a VC's perspective is to make money, but also preserve their brand, right? Because they want to have access to the best deals and, you know, basically participate in the best projects. For the project, their job is to ensure they build sustainable token metrics that, on the one hand, is attractive to investors so they can raise capital and actually, you know, fund development. But on the flip side, is sustainable and isn't going to create, you know, huge overhangs or cliffs that will then just trigger, let's say, 12 months down the line, or doesn't create a completely unsustainable situation where you run out of tokens 18 months into the project and then you're having to do all sorts of weird and wacky things. So the short answer is it's really should be started by the project, and I think it's up to the investors to kind of almost QA a bit of that and actually make sure that what is being built here is being built in both interests, and it will require compromise on both sides to actually make it work.
Yeah, look, I think the ownership is on the founder, obviously, because that's you hold the majority of the interest, and it's your company ultimately, right? The investor always will be at earlier stage and are always going to be in the minority there in advising capacity. Obviously, you should pick your investors. If you feel like you need, you know, tokenomics drops, you should pick your investors accordingly. As mentioned, right? I think the right or wrong tokenomics can, you know, define success and failure. Even a very good underlying project with underlying metrics and team can be killed by the wrong tokenomics. So I think it's very important. But ultimately, I think the owners and ownership needs to be on the founder side, and the investor can challenge, can give inputs, but ultimately decisions with the founder. Right?
One thing I just add as well, guys, with the not all projects need a token. And I mean, we invest with equity and token, but token, in my mind, a utility token, the primary purpose is to coordinate decentralized activity in a trustless way. That's the purpose of it. If you don't need to do that, you probably don't need a token. And probably the value accrues in the IP and the equity of the business. And again, from a VC perspective, we want to invest in the thing that accrues the value in the business. If it's a decentralized network, then of course, more value accrues in the token. That is the right vehicle to get exposure to. But I think it's also important that you know when to launch a token. The deal structure is correct. So often the common structure is equity with the token warrants, and there's a conversion ratio. Some do equity only, and then maybe there might be a token later. Some do token only. So there's different ways, and there's no right or wrong for it, but just being cognizant that, yes, token provides quicker liquidity, both from a project and a VC perspective, but often it's a bit of a red herring because then you spend too much time focusing on token as the product rather than focusing on the actual product, which is going to build the sustainable business model for the project.
Cheers, Yaroslav. We're going to have to cut you off there. Apologies. But yeah, well, thank you. Big round of applause to our panel. Thank you for coming up. Really appreciate your time.